right, now we're going to be looking at the sales side of these transactions, okay? So now we're manufacturing these items and we're selling these items. And in this case, I've already started the journal entry. Let's say that we're selling some inventory of items of ours for $800. Let's say they cost us $600, okay? Well, that's a double journal entry we need to record. We're selling it for $800 on account, then we're gonna have $800 here and $800 here. AR stands for accounts receivable, that's an asset, and then we're going to debit that, and then we're gonna credit our sales. Sales is a revenue account, which increases with a credit, okay? Now, remember I said that we sold items costing $600. So we're going to debit cost of goods sold, COGS, cost of goods sold, which is an expense, and then we're going to credit inventory, which is our asset. Debit this for $600 and credit the inventory for $600. So hopefully you can see from this journal entry that we sold it for $800, but it cost us $600. So sales minus cost of goods sold is the profit. So we have profit of $200 on this transaction at this time, okay? Now, let's say the terms for this were 110 net 30, meaning we'll get a 1% discount. They'll get a 1% discount if they pay within 10 days. But the whole thing's due in 30 days no matter what, okay? So let's say on May 8th, they pay us, okay? So they're gonna pay us, and the entry will be cash. They're gonna get a 1% discount, okay? A 1% discount, and they owe us $800, but 1% of that is $8. So they're not gonna pay us the full $800, they're gonna pay us $792. And then we're going to eliminate our account. Now I'm gonna leave some space here. We're gonna eliminate our accounts receivable for $800 because it's still in our books $800. We have to eliminate that because they're paying us, so we have to eliminate that accounts receivable of $800. You'll notice that our journal entry is not in balance. To get it to balance, we need this $8. And the entry we're gonna record is sales discount. The entry we're gonna record this into, the account, is sales discount, okay? So now, previously I said our profit was $200. It's not $200 now because we have sales, I'm gonna kind of abbreviate here, sales of $800 less, I'm gonna abbreviate, sales discount of $8, so that's $792 less the cost of goods sold, which was $600 because that's an expense, so it's $192. Okay, so there is our profit. It's $192 because previously it was $800 minus the $600, $200, but we're giving them a discount of $8. We want to track the sales discount separately so that we can know how much discounts our customers are getting from us. How much are they taking advantage of? Okay, so this sales discount has a debit balance. It is a contra revenue account. It's a contra revenue account. It goes with sales, but sales is a credit balance and the discount is a debit balance because it reduces our sales. So our net sales then would be $792. Our gross sales are $800, our net sales would be $792. Okay? Our next video we're going to go over sales returns and allowances. We've done purchase returns and allowances. Now we're going to do sales returns and allowances.